What you're about to hear changes everything you thought you knew about silver. Right now, a clock is ticking. A window that insiders have been quietly exploiting for months is slamming shut, and the average American retirement saver has no idea it's even open. So, before we get into what the big institutions are doing behind closed doors, before we expose the mechanics of what's actually happening inside the world's most important precious metals exchange, I need you to understand one thing. This is not a drill. This is not clickbait. The conditions converging in the silver market right now are unlike anything we have seen since the early 1980s. And the people who act first are going to look back on this moment as the defining financial decision of their lives. Let me paint you a picture. Imagine a warehouse, a real physical warehouse somewhere in a major American city, filled with silver bars stacked floor to ceiling, vault after vault, the product of years of mining output from Peru, Mexico, Bolivia, Australia. Now imagine that warehouse draining, slowly at first, a few tons here, a few tons there, and then faster still. And the people who own that silver are not selling it into the open market. They are taking physical delivery. They are pulling it off the exchange entirely, loading it into armored cars, and moving it somewhere you and I will never see again. That is what is happening right now on the COMEX, the commodity exchange in New York that sets the global paper price of silver. And when I tell you the registered inventory number, the number of ounces actually available for immediate delivery on that exchange, I need you to sit with it for a moment, because it is staggering in its implications. Roughly 84 million registered troy ounces remain available for delivery on the COMEX. That sounds like a lot until you realize that silver's global annual industrial demand alone consumes over 600 million ounces per year, and rising. It sounds like a lot until you realize the open interest on COMEX silver futures represents paper claims on silver that vastly exceed the physical metal sitting in those vaults. Analysts who track this stuff obsessively have done the math, and the ratio of paper silver to physical silver that can actually be delivered sits somewhere between 8 to 1 and 15 to 1 on any given day. That means for every single ounce of silver sitting in a COMEX vault, there are somewhere between 8 and 15 people holding a contract that says they own it. Only one of them can actually have it. This is the powder keg, and someone just lit the fuse. Before I get into exactly who is lighting that fuse and why 3 days matters so much right now, real quick, if you want the full breakdown of how to protect your retirement savings with the same precious metal strategies that thousands of American retirees are already using, I've put together a free guide. It's in the description below. It lays out the exact saving secrets, the accounts, the structures, everything. Zero cost to you. Check it out while this video plays. Now, let me get back to what's actually happening. To understand why this moment is so different, why this particular window is closing, you have to understand the history of silver squeezes and what happens when the gap between paper promises and physical reality becomes impossible to ignore. Go back to the late 1970s. Two brothers from Texas, Nelson Bunker Hunt and William Herbert Hunt, had quietly accumulated somewhere between 100 and 200 million ounces of physical silver. They understood something that the financial establishment did not want to admit, that paper money was being debased at an alarming rate following the Nixon shock of 1971, when the United States finally and permanently severed the dollar's link to gold. The Hunts understood that hard assets, real, tangible, undebasable commodities, were the only honest store of value in a world where governments could print currency at will, and they acted on that understanding in the most aggressive way possible. Between 1979 and early 1980, silver went from roughly $5 an ounce to nearly $50 an ounce, a tenfold increase in roughly 18 months. The COMEX, facing the catastrophic possibility that it could not fulfill its delivery obligations, changed the rules mid-game. They banned the purchase of silver futures for speculative purposes. They forced the Hunts to liquidate. Silver crashed back down. The establishment won. The paper market survived. And most people took from that story the lesson that betting big on silver was dangerous and foolish. But that is entirely the wrong lesson. The right lesson is that the physical market was real. The squeeze was real. The gap between paper promises and physical metal was real. And when that gap became too large to ignore, the only way the system could survive was to change the rules and force sellers into the market. The Hunts lost their fortune, yes, But anyone who held physical silver in 1979 and sold it at the peak made 10 times their money in a year and a half. The lesson of the Hunt Silver Corner is not that silver is risky. The lesson is that when paper claims massively exceed physical supply, and when someone starts demanding physical delivery, the price doesn't just go up, it goes parabolic. Now fast forward. Think about 2011. Silver hit nearly $50 an ounce again, the same nominal peak the Hunts had driven it to 30 years earlier. This time, it wasn't one family doing the accumulating. It was a global realization, post-2008 financial crisis, that the central banks of the world had decided that the only answer to a debt crisis was more debt. Quantitative easing, zero interest rate policy, trillions of dollars conjured from nothing and injected into the financial system. Silver responded the way hard assets always respond to currency debasement. It soared. And then, just like in 1980, the COMEX raised margin requirements 5 times in 9 trading days, forcing leveraged buyers to liquidate their futures positions, and silver fell off a cliff. You see the pattern. The paper market has a self-defense mechanism. When physical demand threatens to overwhelm it, the exchange changes the rules, raises the cost to hold futures contracts, and forces liquidation. The smart money, the people who had physical metal in hand, walked away rich. The people who held paper contracts got crushed. So why does any of this matter today? Why does any of this explain why the window closes in 3 days? Because right now, we are at the intersection of 2 forces that have never converged at this magnitude simultaneously. The first force is industrial demand so massive, so structural, and so irreversible that no price increase in silver can fully compensate for it. The second force is a physical supply situation so tight that the paper market is starting to crack at the seams. Let's talk about the industrial demand picture first, because this is where the story gets truly extraordinary. Silver is not just a precious metal. Silver is not just a savings vehicle or an inflation hedge or a portfolio diversifier. Silver is the most electrically conductive element on the periodic table, more conductive than copper, more conductive than gold. And in a world that is simultaneously deploying solar panels at a rate of hundreds of gigawatts per year, electrifying its vehicle fleet, building AI data centers that require massive power infrastructure, and expanding everything from 5G networks to medical imaging equipment, silver is the foundational, irreplaceable input to all of it. A single solar panel contains between 15 and 20 grams of silver. A single electric vehicle contains over 2.5 times more silver than a conventional combustion engine car. A single AI data center, the kind that companies like Microsoft, Google, and Amazon are building by the dozens right now to power the AI revolution, contains silver in its power management systems, its server infrastructure, its cooling systems. There is no substitute. Engineers have tried. They've experimented with copper alloys, with gold contacts, with various conductive composites. None of them match the thermal and electrical performance of silver at the scales and tolerances modern electronics demand. Global industrial demand for silver is now consuming more of the metal each year than the mining industry produces. This is not a projection. This is not an analyst's model. This is a measured, documented, confirmed structural deficit. The kind of deficit that gets worse every single year as the green energy transition accelerates, as AI infrastructure build-out intensifies, and as global electrification deepens its penetration into every corner of the world economy. And here is what makes this different from any silver bull market in history. The demand is not coming from speculators. It is not coming from people betting on a price move. It is coming from engineers and procurement managers at solar companies and electric vehicle manufacturers and semiconductor fabs who need silver to build the things they are contractually obligated to build. They will pay whatever price the market demands because the alternative is shutting down their production lines. That is a qualitatively different kind of demand than anything the silver market has faced before. Now, layer on top of that the supply picture. Silver is primarily mined as a byproduct. Roughly 70 to 75% of all silver produced globally comes not from primary silver mines, but as a secondary output from copper, zinc, lead, and gold mining operations. What this means, and this is critical, is that silver supply cannot respond quickly to rising silver prices. If you run a copper mine and the price of silver doubles, you cannot simply start producing more silver. You can only produce more silver if you produce more copper. And the copper market, the zinc market, the lead market, those markets run on entirely different supply and demand dynamics, entirely different investment timelines. entirely different capital allocation decisions. It takes 7 to 10 years to bring a new mine from discovery to production. Even a massive surge in silver prices cannot translate into meaningfully higher silver supply for the better part of a decade. So you have demand that grows faster than anyone predicted, driven by irreversible structural forces. You have supply that cannot respond quickly because of the byproduct mining reality. And you have COMEX registered inventories that have been steadily draining as more and more institutional buyers decide they want real metal, not paper claims on metal. This is the setup. And the 3-day window I'm referring to connects directly to what institutional traders watch more closely than almost any other technical trigger in the precious metals complex. When COMEX futures contracts approach what's called first notice day, the point at which futures holders must either roll their contracts forward or take physical delivery, the registered inventory in COMEX vaults becomes the critical variable. If the number of contracts demanding delivery approaches or exceeds the registered ounces available, something extraordinary happens. Prices don't just rise, the market structure itself begins to shift. Backwardation, the condition where the spot price for immediate delivery exceeds the future price, begins to emerge. And backwardation in any commodity is the clearest possible signal that the physical market is screaming that there is not enough metal to go around right now, at any price. Right now, the silver futures curve is showing early signs of exactly this dynamic. The gap between prompt delivery prices and futures prices is compressing in a way that sophisticated precious metals traders are watching with intense focus. This is not theoretical. This is the market telling you something in the only language markets know how to speak: price signals and structural mechanics. And here's what makes this moment particularly urgent for anyone sitting on retirement savings in traditional financial instruments. The people who know what this signal means are already acting. The big institutional buyers, the ones who can pick up the phone and wire 9 figures in a single afternoon, have been quietly accumulating physical silver through mechanisms most retail investors don't have access to. They are pulling ounces off exchanges. They are setting up allocated storage arrangements with Swiss and Singaporean vaulters. They are doing what the Hunt brothers did, but with the sophistication and resources that 40 years of financial evolution have produced. The retail investor finds out about these moves after the fact. By the time the headline on a major financial publication says silver surges past all-time high, the smart money has already been positioned for months. JP Morgan is projecting silver to average significantly higher than current levels over the coming year. Goldman Sachs has put out targets suggesting prices could breach 3 figures per ounce. These are not gold bug newsletter publishers. These are the largest financial institutions in the world, with teams of commodities analysts who spend every working day analyzing supply and demand data. When Wall Street's most prestigious addresses agree that silver is headed sharply higher, the question is not whether you believe them. The question is whether you act before the window closes, or after. Now, I want to talk about something that most silver analysis misses entirely, and that's the geopolitical dimension. Because what's happening in precious metals right now is not just a commodity story. It is a story about the architecture of global finance itself. For decades, the dollar has sat at the center of the world's monetary system. Every commodity, oil, copper, iron ore, soybeans, silver, gold, is priced in dollars. Every central bank holds dollars as its primary reserve asset. Every international trade settlement flows through dollar-denominated systems controlled ultimately by Washington. This arrangement gave the United States extraordinary power, the ability to impose sanctions, to lock adversaries out of the global financial system, to finance its own deficits at lower rates than any other nation on Earth, because global demand for dollar-denominated assets was guaranteed. But something has changed. The decision to freeze Russian central bank reserves following the invasion of Ukraine sent a message to every central bank in the world that was not geopolitically aligned with Washington. Your dollar reserves can be weaponized against you. And the response has been a quiet but accelerating shift away from dollar reserves and toward hard assets, gold primarily, but silver by extension, that cannot be frozen, cannot be sanctioned, and cannot be made worthless by a policy decision in a foreign capital. The BRICS nations, Brazil, Russia, India, China, South Africa, and the growing coalition of countries that have since joined or affiliated with that bloc, have been accumulating gold at rates not seen since the Bretton Woods era. China's central bank has been the most aggressive accumulator, adding to its gold reserves consistently, transparently, and with what can only be described as strategic deliberateness. This is not portfolio diversification. This is infrastructure for a post-dollar monetary order. And silver, while not yet explicitly targeted by central bank accumulation programs, benefits from exactly the same forces driving gold higher. When the dollar is under structural long-term pressure, when global trust in paper financial instruments is declining, when more and more of the world's savings are looking for a home that isn't denominated in a currency controlled by a government that can inflate it, devalue it, or simply confiscate it by executive order, the hard assets benefit. Gold first, silver close behind. The gold to silver ratio right now tells a fascinating story. To buy 1 ounce of gold today, you need somewhere around 64 ounces of silver. That ratio has historically averaged closer to 15 or 16 to 1, reflecting the natural geological occurrence rate of the two metals in the Earth's crust. At points in silver's most bullish historical moments, 1980, 2011, the ratio compressed all the way to 32 to 1 or below. If silver were to simply return to its historical average ratio against gold at current gold prices, we would be looking at a silver price that is several multiples of where it trades today. That's not a prediction. That's arithmetic. The metal is measurably, demonstrably, historically cheap relative to gold, and gold itself is at all-time highs, north of $4,000 an ounce, driven by exactly the forces we've been discussing: de-dollarization, central bank accumulation, geopolitical instability, and the inexorable mathematics of fiat currency debasement. Now, I want to pause here for just a moment, because if you're watching this and you're approaching or in retirement, or you've spent decades building a nest egg in a 401k or an IRA or a pension rollover, what I'm about to say is directly relevant to your financial security. If you have $100,000 or more sitting in a retirement account and you're watching global instability, currency debasement, and markets that feel increasingly disconnected from economic reality, there is a way to get physical gold into your retirement account. It's called a gold IRA, and most people have no idea it exists. I put together a free guide that walks through exactly how it works. No tax penalties, no early withdrawal consequences, just a direct rollover into an IRA that holds physical precious metals. It's in the description below. It takes about 2 minutes to read. If that's relevant to where you are financially, that guide could be one of the most valuable things you look at today. All right, back to the market analysis, because here's where it gets truly fascinating, and I want to bring in a historical parallel that almost nobody is talking about. The year is 1971. Richard Nixon is in the Oval Office. The United States is running trade deficits, financing a war in Southeast Asia on borrowed money, and the dollar's pegged to gold, the foundation of the Bretton Woods system established after World War II, is under pressure. Foreign central banks, led by France's Charles de Gaulle, are demanding gold for their dollar reserves. The U.S. gold stockpile at Fort Knox is draining. Nixon's advisors, led by Treasury Secretary John Connally, tell him the math doesn't work. You cannot redeem every dollar overseas with gold at the stated rate. There isn't enough gold. On August 15th, Nixon goes on national television. He tells the American people that the United States is temporarily suspending the dollar's convertibility to gold. Temporarily turned out to be forever. In a single Sunday night broadcast, the monetary system that had governed global trade and finance since 1944 was dissolved. The dollar became a pure fiat currency, backed by nothing except the full faith and credit of the United States government. What happened next? The price of gold, which had been fixed at $35 per ounce under Bretton Woods, rose to over $800 per ounce by 1980. Silver rose from less than $2 per ounce to nearly $50. In each case, the metal moved because people began to understand what fiat money really meant. It meant that the supply of currency was now theoretically unlimited, constrained only by whatever political will existed to maintain fiscal discipline. And political will, as history shows us repeatedly, is the most unreliable constraint ever invented. We are in a parallel moment now, except the stakes are arguably higher. In 1971, the dollar was simply losing its gold peg. Today, the dollar is losing its reserve currency status, slowly, unevenly, but unmistakably. The countries that have been most dependent on the dollar-denominated financial system are building alternatives. The SWIFT payment system is being paralleled by Russian and Chinese alternatives. Dollar-denominated oil contracts are being supplemented by yuan-denominated ones. The infrastructure of de-dollarization is being assembled piece by piece, And the end destination of that process is a world in which the dollar's privileged positioning is shared with or displaced by a basket of currencies or commodity backed alternatives. That process doesn't happen overnight. It happens over years and decades. But in the early stages of that process, the assets that are neither dollars nor dependent on dollar credibility, gold, silver, hard assets generally, will be repriced to reflect their scarcity and utility in a world where the old monetary anchors are failing. Now let's go even deeper, because I want to walk you through what most mainstream financial coverage completely misses about the silver supply chain. The world's largest silver producing nations are not run by governments that are friendly to Western financial interests. Mexico produces more silver than any other nation on Earth, nearly a quarter of global mine supply. Peru is number 2. Bolivia, Chile, and Russia are significant producers as well. These are countries with political volatility, resource nationalism, infrastructure challenges, and in some cases, explicit hostility to the kind of institutional investor interests that have historically dominated Western financial markets. When a major mine in Mexico or Peru gets hit by a labor strike, and these countries have long histories of mining labor disputes, supply disruptions happen fast. When a government decides it wants a larger share of mineral royalties, which is an increasingly common political position across Latin America, the economics of mine expansion deteriorate instantly. When geological challenges at an aging mine force reduced output, there is no quick replacement. Silver mines don't just spring up because the price is high enough. China, meanwhile, has become a critical node in the global silver supply chain in a different way. China is both a major consumer of silver for its solar manufacturing industry, its electronics sector, and its electrical infrastructure build-out, and a significant holder of silver inventories in its internal market. The degree to which Chinese silver moves onto or off of global exchanges can materially affect the price picture. And given the current state of US-China trade relations, tariffs, technology controls, geopolitical tensions that show no sign of abating, the willingness of Chinese entities to make their silver available to Western buyers is not guaranteed. What this creates is a supply landscape of extraordinary fragility. The silver that the world's solar manufacturers, electric vehicle companies, and electronics producers need doesn't just materialize on demand. It comes from specific mines in specific countries through specific supply chains, and any disruption at any node in that chain cannot be quickly compensated. Against this backdrop, when you look at the COMEX registered inventory, when you look at the ratio of paper claims to physical metal, when you watch the futures curve starting to flash early backwardation signals, you are watching the visible tip of an iceberg that runs very, very deep. Let me tell you about what JP Morgan's commodities desk wrote in their most recent research note. They are projecting silver to average significantly above current spot prices over the next 12 months. Goldman Sachs sees an even more aggressive upside case, a scenario where prices break through triple figures per ounce if the supply deficit continues on its current trajectory, and investment demand joins industrial demand in pushing for physical metals simultaneously. These are institutions that rarely stick their neck out with bold precious metals calls. When they do, it's worth paying attention. And here's the thing about silver that makes it uniquely compelling compared to gold for a certain kind of buyer. Gold is predominantly a monetary metal. About 70% of gold demand is investment and jewelry. Only about 30% is industrial. Silver is the opposite. Well over half of silver demand comes from industrial applications. Applications where the buyer is not investing, not speculating, not hedging, but producing a product that someone is contractually waiting for. That industrial floor under demand is real, structural, and non-negotiable in a way that investment demand simply cannot be. This is why silver's supply deficit is qualitatively different from gold's. Gold can theoretically absorb a drop in investment demand. If investors decide to sell gold, that supply goes back into the market and provides a buffer. Silver's industrial users don't sell their silver back. They use it. It gets absorbed into solar panels and circuit boards and medical devices and catalytic converters, and it is gone. The above-ground available supply of silver is shrinking in a way that is mathematically inevitable given the current demand trajectory. Now, here is what I want to leave you with, and I want to be very direct because I think there's a tendency in coverage of precious metals to dance around the most important point. We are living through a period of genuine, profound monetary disorder. The national debt of the United States has reached a level where the annual interest cost alone exceeds the defense budget. The Federal Reserve has spent years creating the largest balance sheet in the history of central banking. Global debt as a percentage of global GDP is at levels that, historically, have only been resolved through inflation, default, or currency devaluation. None of those outcomes are good for people who hold their wealth in cash or in financial assets denominated in the currency being devalued. The people who navigate this kind of disorder successfully, and there have been people who did so in Weimar Germany, in 1970s America, in 1990s Argentina, in 2000 Zimbabwe, are the people who understood the difference between paper promises and real things, between claims on assets and the assets themselves, between a number in a database at a brokerage firm and a physical ounce of metal that has no counterparty risk, no third-party dependency, and no government's ability to make it worthless by running a printing press.